Welcome back to another video. My name is Jakub, and as you might know, we often talk with CEOs from popular P2P lending sites to bring more transparency into the industry. Usually we cover advanced topics, and I realize that sometimes it can be quite confusing if you don't understand the context. So in this video I will cover some of the basics of P2P lending and explain various business models so you are fully aware how the ecosystem works. This is particularly important as it influences the risk and returns that you make with P2P lending. If you are new to this channel and your goal is to become a more educated investor, please consider subscribing and hit the like button to see more videos like this in the future. So first of all, it's important to understand the traditional lending model. Let's say you need a loan to purchase a car. Typically, you go to your bank and fill up the loan application. The bank evaluates your credit score, and if you are worthy, the bank lends you the money. In this scenario, the bank funds the loan with the capital it gets from the central bank or its customers who deposit their funds in order to receive a fraction of an interest. That's at least a simplified version of how traditional banking works. There are, however, a few challenges that banks are facing. It's not always easy to obtain a loan from a bank. The banking system in certain countries is not very innovative, which opens doors to non-banking lenders, which are companies that own a lending license and take the role of a lender. Those companies typically develop an automated lending process which allows borrowers to borrow money instantly. As you remember, a bank gets its funds from its customers or from the central bank. A lending company doesn't have access to this capital, which is where P2P lending comes in. In order to be able to give out loans and further expand its lending business, many lenders borrow money from the crowd. You, as an investor, will invest in loans in exchange for an interest. The interest is typically much higher than what you get in a bank if you open a savings account, because the risk connected to lending money through P2P lending platforms is also much higher. The requirements for borrowers who borrow money from alternative lenders are usually not as strict as from the bank. So this was a simplified definition of how P2P lending works. There are different business models which have an impact on the security and returns of your investments. Let's go over them so you understand the differences and decide for yourself which is the best fit for you. So first, let's talk about P2P platforms. We have already briefly mentioned how P2P platform works. So first, a group of investors invest on a platform which is also the loan originator. The loan originator is a term you will likely come across at some point. It's a synonym for the lending company. In the second step, the lending company lends money to its borrowers. If it's a personal loan, the borrower returns the loan with additional interest to the lending company. Usually you will receive the loan principal and the interest at the end of every month. In the last step, the lending company deducts a fee and transfers the rest of the money back to your investor account. When using P2P platforms, you invest directly in loans from borrowers. Typically, you know more about the borrower's financial situation, as sometimes the platform also reveals additional information like income, age, gender, and the country of the borrower. The lending company does its own credit check of the borrowers to make sure the borrower is able to repay the loan. If the borrower isn't able to repay, the lending company takes charge of the debt collection. So what are the benefits of this business model? Well, you know exactly where you invest your money into. It's less risky as lending companies have direct access to the borrower. Often the lending company has the right to access the borrower's income in case the borrower fails to repay the loan. P2P platforms are also typically more transparent as they share more information about the borrowers, as let's say P2P marketplaces, which we will talk about in just a minute. There are, however, also a few disadvantages. When investing on a P2P platform, there aren't always enough investment opportunities that match your preferences, as you have access to just one pool of loans originated by just one lending company. The diversification of your portfolio is limited to only loans from one company in one segment in markets where the lender is operating. Many P2P platforms fund unsecured consumer loans in developing countries, which means that you should certainly not put all your savings in this asset class. So that's how the P2P platform works. If you are looking for a more modern approach, you might want to invest on a P2P marketplace instead. The P2P marketplace is not a lending company itself, it's just a middleman that lists loans from a variety of lending companies. And here's how it works. So first, you invest your money on a P2P marketplace. The P2P marketplace sends the money to the loan originator, and the loan originator lends the money back to the borrower. The borrower returns the money with additional interest to the loan originator, which transfers the funds back to the P2P marketplace. The P2P marketplace then deducts a fee and returns the funds back to your investor account. So there are a few things you should know about P2P marketplaces. You can invest in multiple loan originators simultaneously, which are being monitored by the P2P marketplace. Usually, the P2P marketplace does not share any information about the borrower. Because you as an investor have access to a bigger pool of loans, it makes the diversification of your portfolio easier. Another benefit offered by the P2P marketplaces is that your investment is secured by buyback guarantee, which means that the loan originator will repurchase your investment if the borrower is late with its payments for extended amount of time. Now, let's talk about some of the disadvantages that you should be aware when investing on a P2P marketplace. The platform's assessment of their loan originators are not always accurate, which means that in a more turbulent environment, the lender might default and your money is lost. P2P marketplaces also rely financially on their loan originators. This means that the more funds the marketplace provides, the higher the commission they get. Most of the loans on P2P marketplaces are unsecured consumer loans, which adds a certain risk into your portfolio. By now, you are familiar with some of the most popular business models. As you have noticed, both models don't provide much securities as you are mostly investing in unsecured personal loans. Now the next business model changes things a little bit, and I will explain why. Another type of platforms are peer-to-business platforms, so let's just call them P2B platforms. A P2B platform isn't lending money to consumers like a P2B platform, but businesses. Those businesses typically provide additional securities such as a mortgage, business collateral, or personal guarantees. So let's have a look at how this works. So first, you invest on a P2B platform, which is also the loan originator. The lending company lends money to the business, which provides collateral for its loan. Then the business returns the loan with the additional interest to the P2B platform, which deducts a fee, and the rest goes to your investor account. So what else should you know about P2B loans? Well, in most cases, your investment is protected by a collateral. These loans are more suitable for experienced investors that tend to invest long term. Your investment in businesses typically creates some kind of value. There isn't much value of funding consumer loans. Another quite important fact is that the interest rates and loan principals are often repaid after the end of the loan term rather than on a monthly basis, which means that you won't see incoming interest on loan principal right away in your investor account. So what are the benefits of investing on a P2B platform? Well, your money is often protected by a mortgage if you fund a real estate loan. The potential return from your P2B investment is also higher, but this highly depends on the securities as well as on the P2P platform itself. While the benefits of P2B platforms are quite impressive, there are also a few disadvantages that you should be aware of. The minimum investment amount on P2B platforms is also a bit higher. Usually you can start investing from €50 into one project. Most investors, however, invest much higher amounts. The problem with this particular business model is also that it's popular among scammers who like to lure investors into high-yielding investments just so they can vanish with investors' money. There are also quite some differences between individual P2B platforms when it comes to the securities and returns. I highly recommend checking out our reviews on P2P Empire to be fully aware of all the risks, since some P2B platforms are less transparent than others and you don't want to invest in a platform to lose your money. Moving on to the next business model, the P2B marketplace. P2B marketplaces list loans from loan originators that fund business loans only. The only difference to P2P marketplaces is that the borrower isn't a private individual but a company. So here's how it works. You invest your money on a P2B marketplace, which sends the money to the loan originator. The loan originator then lends the money to the business, which returns the money with additional interest back to the lender. The loan originator transfers the funds back to the P2B marketplace, which deducts a fee and adds the funds back to your investor account. Your investment on P2B marketplaces is protected by collateral or personal guarantees of the business owners. This investment type is suitable for more advanced investors. The diversification and the loan availability is typically lower as there aren't as many solid loan originators in the business loan sector. There's currently just one P2B marketplace, Debitum Network. This platform does a really good job in monitoring the financial performance of the lenders and protecting your money. P2B marketplaces share a lot of features of the P2P marketplace model, which we have covered earlier. The return is, however, slightly lower in exchange for higher protection of your investment. The benefits are obviously the higher protection as opposed to funding unsecured loans, and the monitoring quality is often also better compared to P2P marketplaces. The disadvantages are the lower returns, and you don't have instant access to your money as there is no secondary market so far. Let's move on to the last business model within the P2P lending sector, which are REITs or buy-to-let properties. REITs or real estate investment trusts are real estate companies that own and manage properties like office spaces, apartments, or warehouses that generate regular rental income. So how does this model work? You invest money into a property on a real estate platform. After the funding target is reached, the REIT repurchases the property and rents it out to tenants, which then transfer their monthly rent to the REIT. The REIT pays out monthly rent back to your investor account. If the REIT sells the property at some point in the future for a higher price, you will also receive higher returns from the capital gain. So what else should you know about REITs? You receive a monthly income, and REITs are also suitable for more advanced investors with a longer investment term who are looking to invest into secured assets. The disadvantages are typically lower monthly returns, and the total return also depends on how the prices in a market fluctuate. In case where the property is vacant, you don't get any income. So if you want to learn more about investing in rental properties, I highly suggest watching our P2P talk with the CEO of Reinvest24, where we dive deeper into this topic. So now you might be asking, what is the best P2P lending business model for you? Well, it comes down to your investment goals and how risky an investment you are prepared to make. If you're just starting out with P2P lending, a P2P marketplace is going to be the best fit for you. If you want to diversify your portfolio, joining a P2P platform with a long-lasting track record is also a solid approach. If you want to bring more safety to your P2P portfolio, you should consider investing in P2B loans that are backed by a mortgage. And if you chase the highest returns and don't care about transparency, you can also invest in business loans that aren't protected by a mortgage. This does, however, come with a certain risk, which is often not justified by the higher interest. So that's all I wanted to share with you today. If you want to learn more about individual investment types, navigate to our P2P Lending Academy on P2P Empire. And if you want to learn more about specific platforms, head over to our review section where you will find all the info you need in order to find the best fit for you. As always, if you have any other questions, ask them in the comments below this video. Thanks for watching, and I will catch you in the next one.